nearly 5% today, posting its highest close since late last month. The stock has so far outperformed the broader market and its streaming peers so far this year. The latest move coming after the Wall Street Journal reported the company aims to double revenue by 2030 and targets a market cap of $1 trillion. That would mean an almost 140% rise in shares. All this, of course, as investors looked at Netflix's Q1 earnings report after the bell on Thursday. This will be the first quarter the company does not break out paid subscriber numbers. It reported just over 300 million at the end of last year. But will those results help boost the stock further? Is it, in fact, Teflon to tariffs? Guy, what do you think?
I hit a 5% move in earnings. Decent volume day, but I think you got to stay the course. Valuation will be a concern for a lot of people, but it's been a concern for a long time. And outside of maybe 2, maybe 3 times over the last decade, they really haven't taken any missteps. So when they tell you you're going to be a $1 trillion company in the next 5 years, to a certain extent, you got to believe them because they've done everything, almost everything right over that period of time.
Yeah, I agree with Guy. I mean, it's a lofty goal, right?
Yeah.
But when you consider, the history of this company, the transformation from the red envelope to then to streaming, to then doing their own content, to having that really work, to then switching, gears and going to the ad tiers. I mean, they have done everything right. And I think that, today I thought, all right, stock's going to be up a lot. That was obviously a very bullish article. And so I'm going to look to sell some upside calls. And then I thought, well, I'm guessing that this big $1 trillion goal didn't start with, well, this quarter's going to be really bad, but going forward. So I feel like they probably feel like they have some momentum. Whether that's priced in, I don't know. I am long. It is expensive. It is hard for me as a value person to keep this, but they've just continued to dominate. And I'm trying to think, is there an industry, maybe Tesla early on in the EV evolution, that was it. There was no one else. I feel like they are so far ahead of everyone else here.
A lot of folks say, oops, sorry. A lot of people say it's like recession-proof. But if you go back to 2022, there was an earnings recession. There was an economic recession. I think consumers pulled back a little bit. Stock's still left 70% from its all-time highs, And so I just do think that's interesting. The less clarity, I know you don't like guidance, but, the idea that this company is not breaking out a very important metric that really did guide the stock. And I don't think it was one of those things that if they, for the last 5 years, had not been breaking out subs, that the stock would have acted too differently when it was down in 22 or when it's been up, 7-bag or whatever. Since then, I will tell you this, though. I've never really, other than Elon, heard a company guiding to a market cap level. Have you guys heard that? I've never heard that. It just seems very odd to me, like suggesting that, how do you get there? You know what I mean? Like that, like,
well,
as
that's
far as
right. But I would think it's guiding to a revenue level and a profitability level. And
but did they give it? But they didn't give us that.
They did.
Really?
Did.
I mean, the revenue they did.
Revenue
but
goal, yes.
Double revenue.
Yeah, but like, all right, but what are the margins? Is advertising, the ad tier, is that growing? What does the advertising situation look like? X that. I just think it's just a very odd thing because there's a lot of things that go in to make the sausage, and we just don't know what that stuff is.
Well, to be clear, this is an annual it wasn't for analysts, it wasn't for investors. It was sort of an internal
they knew it was
bar that they were setting. But Tim, in terms of this notion of being recession-proof, I mean, the analysts in the street who've all come out pretty bullish in the past couple of days, even into earnings, will say that if you look at past recessions, people spend less money on going out to eat and things like that, trips, but they will spend on Netflix still. So it is, in that respect, maybe. It could be more recession-proof.
Well, I mean, it's certainly market volatility proof. I mean, it's outperformed the S&P by 10% since April Fool's Day, when a lot of bad stuff started happening. Disney's underperformed the S&P by 10%. So in terms of performance and how the stock behaves, no question. The analyst community is extremely excited about Avenue revenue as a percentage of overall revenue, and there's a view on anywhere from 10 to 20% somewhere out in the next few years. If you think that that's part of how they get to $1 trillion market cap, then this is something that certainly has an enormous amount of cyclicality to it. I just think that their ability to grow on multiple fronts and the numbers for the first quarter, they really just need to show that there's not a whole lot of churn after a last quarter where the net adds were amazing, and they also had a price raise. So I think the content slate remains great. I know Guy's a big fan of Adolescence, which is one of its top shows and one of the top shows of 5 shows of all times. So, I don't see why you're getting too far away from this one, and I think you pay more for it.
I enjoyed season 1 a great deal of Adolescence.
Mel likes adolescents.
I thought it was an amazing limited series, so there is only one season
Oh, that,
of that show.
silly me. Real quick, though, Tim's point, and Karen, I mean, look at what it's done in this period of time of market uncertainty. I mean, this is a stock that's, with that market cap, I mean, it's one of the mega cap stocks that is basically flirting with its prior all-time high made, a couple months ago. It's hanging in there, I guess, like a champ in the wake of a lot of stocks not performing well at all.
Bank of America, it's a defensive choice for investors. Evercore added it to the tactical outperform list, saying that $7.99 a month is the best value for your entertainment dollar out there. Oppenheimer says no tariff exposure, limited consumer risk.
It's a lot
There's
to like.
a lot of bullishness going into their print.
Right, we saw them. They were advertising capacity restricted, right? And so as they addressed that, so there's a lot to like here.
Let's bring in media trailblazer and CNBC contributor Tom Rogers. Tom served as NBC cable president, now executive chairman of Orbit Media and Entertainment. Tom, it is always great to see you. Welcome.
Always great to be here, especially to talk about Netflix.
I know you've loved it for a very long time. You've always said that it's Netflix's world and everybody else lives in it. Are we getting too bulled up, though, ahead of the print? I mean, is at least short-term a concern?
Well, I don't think this quarter is a concern. A guy likes to throw around the word stud for some reason, S-T-U-D. That applies to Netflix. Staying tough under a downturn. And I think it can stay tougher under a downturn than just about any other media stock for good reason, which is that it's only got about 4% of its revenues that relate to advertising. And advertising, of course, is what will get most hit in a recession. And when you look around, whether even if you're talking about guys with great growth rates like Facebook, who probably get 98% of their revenue from advertising, they're all going to get hit. With Netflix, near term, that doesn't mean much to their top line. Obviously, over the next 5.5 years and getting to $1 trillion market cap, advertising has to perform very well, but because they are more defensive, they're not going to be digging out of a hole if the downturn comes, relative to what kind of hole I think most other media stocks will probably find themselves in.
Tom came up with his own acronym. I like that. You've had 24 hours to think about this $1 trillion market cap. I mean, if you were in the seat, how do you get there? Because I'm sure you have some thoughts about that.
Well, I don't really think it's that hard to get there. You probably have to get to about 400 million subs, which is 100 million more than they currently announce, which is 20 million a year. Remember, last quarter, in the quarter, they did just about 20 million. This year, though, they're looking on a trajectory as if they'll get pretty close to 30% margins, EBITDA margins, and getting to 40% EBITDA margins in 4.5 years is probably eminently doable. I would say their advertising business is going to have to take off. It's going to have to scale. But Netflix is a scale player, and scale begets scale, and they're already getting upwards of 45 to 50% of their new subs coming in on advertising, getting to 25% of their subs by 2030 or 100 million subs, which will give them plenty of advertising scale, gives them the ability to really drive high margin revenue coming off of what is a new revenue stream for them. So you put those variables together, and they're probably tripling their bottom line and doubling their top line, and at the kind of multiples that don't have to look quite as extended as their current multiples, you get to $1 trillion. It's basically doubling what their February high was in terms of their market valuation. The market as a whole over that period of time, if historical trends hold, probably up 70%. For Netflix to be up 100% from its high is probably not a huge reach.
Oppenheimer had a note out, Tom, saying that in the past recession, 2008, 2009, people actually increased TV time at home, and that bodes well for Netflix. Assuming that is correct, that people will increase TV time should there be a recession this time around, does that enable other players to gain any share if the pie is just bigger?
Yes, it does. I'd say the one caveat to the analysis I just laid out is that Netflix engagement has to stay strong. Engagement is what drives pricing power. Engagement is what will drive their advertising revenue. And relative to January, when Netflix was about 8.5% of all viewing time, they dropped below 8% in the March numbers. And the real beneficiary of that was YouTube and the free streaming services, the so-called fast channels. So, free is going to do very well in any kind of downturn. Netflix has to hold its engagement. That was a little troubling, and if there's one area of trouble that I expect them to address on the earnings call on Thursday, it would be that.
In a recession scenario, Tom, do any of the streamers get mortally wounded?
Well, I don't think these streaming services per se get mortally wounded, but if you're a Disney, between your advertising revenue and your park revenue, you're approaching high 40% of your total revenue. Both of those revenue streams are going to get hit very hard. And Disney is above other streamers, below Netflix. It's shown some real growth prospects there. It gets harder to manage streaming growth if the rest of your company is under that kind of duress, and I would expect a player like that to really have to think about how it cuts back in an environment where almost 50% of its revenue streams get hit.
Tom, it's always great to see you. Always great to get your analysis. Thank you.
Thanks for having me.
Tom Rogers. Interestingly enough, UBS just late Monday cut the price target on Disney for those very reasons, the high exposure in terms of parks as well as advertisement and how they are vulnerable to recession here.
Oh, for Disney, I thought it meant for Netflix.
For Disney, yeah.
Right. I wonder, so in the content race, do any of the ones you talk about being sort of behind and potentially wounded, I don't know if that opens up the idea of content being cheaper for the king of the hill.
Ah, interesting. Tim, what do you think about Disney?
I think it's at $85. It's a pretty interesting